Hello and welcome to episode 353 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leakes. Damien, welcome back to the show. We're here again. It's another Sunday. How are you doing?
I'm great. I feel like positively free after the COVID onslaught in my household. So having got through that without actually coming down myself, I'm just pleased that I'm able to do a podcast. I was dreading that I was going to end up coming down with it myself and then not be able to record because I had a croaky voice or something. But touch wood, I seem to be okay. So no, everything's good. And do you know what? After last week's show, Andy, I have to say it was something different. It was your idea to do a podcast episode that told people about the breadth of content and services that we provide at Money to the Masses. And it was so well received by people saying they didn't realise half the stuff we did and appreciating all the things that we do. And we've had some great feedback from people, a couple of reviews, which you're going to come on to, but emails as well, where people have written in to thank us for the content and what we do, and also the team, which was fantastic. And I do share those emails with the team because they are incredibly motivating for people, because you've got to realise that when you're working like we do, we don't see the interaction or have that feedback with people because it's obviously all online and we are in a world where we can't meet up. And I am desperate to do another podcast meetup because I'd love the team to be able to come along and meet a whole bunch of the listeners as well. So we're going to keep mulling over that one and try and determine when we think it's the right time to go out and have a meetup. If you think it's now, then bombard us with messages in the Facebook group or email, Twitter, whatever, and we'll see what we can do. So I'm feeling incredibly positive about 2022 at the moment. And it's a real feel-good factor at Money to the Masses right now.
Well, let's keep that feel-good factor going while I read out these couple of reviews that we've received. And thanks ever so much for sending them in. If you want to send us positive stuff, you can obviously do that via email to Damien and I, but you can also review the podcast. It really does help us to spread the word. So the first one that we received this week was from Eva, and it just said, thank you. Over the past couple of years, this podcast has taught me more about money than my previous 30 plus years of schooling and university education combined. Thank you for your work. It does improve quality of lives, and it sure did for me. With best wishes. And the next one was from Richard, and it just said, great podcast. I love this podcast. Some great information, always some useful practical ideas to implement. A great source of personal finance info with two fantastic presenters. I'll take that. This week's show was a reminder that there is so much more than just a podcast, and I look forward to diving in. So thanks for those two pieces of great feedback. As Damien said a minute ago, it really does give us that sort of oomph, especially in the new year, that we're doing the right thing. And there's lots more to come where that came from.
Yeah, and the Eva and Richard there who had sent in those reviews, do get in touch with Lauren at moneytothemasses.com. That's the email address, and she will send you out a couple of mugs. And also thank you to Josh, who sent in an email that I shared with the team, which was incredibly motivating. I'm not going to read it out, but Josh, thank you. I will be replying to that particular email, actually. So please do leave reviews via the apps that you use, because it does make a difference.
Okay, and so let's get on with this week's podcast. And I'll usually pass straight over to you, Damien, to explain what's coming up in the show. But actually, I'm going to briefly explain what's going to come up first in the show, because we've got Laura coming back on the show, and Laura and I will be talking about a new initiative from a charity that will enable people on low incomes to get access to loans to enable them to buy the essential food items to keep, the family fed. And so what are the other two pieces coming up on the podcast?
So the other two pieces, we're going to do an investment piece. I'm going to be talking about diversification. It's based upon a question I actually got from somebody who's an 80/20 investor member, and I thought it'd be a good piece for the podcast, a much wider discussion about why bother diversifying. And it's a very valid question that the person asks, and I just want to give it some context on the podcast. And the other thing I want to talk about is budgeting. So this week was the second week of our 28-day financial fitness challenge. If you recall, we're doing the Own It phase, where you put down information about your finances. And we're now at the stage where people are starting to build a budget. And I'm going to come on to explain what they were doing. There's a spreadsheet that any podcast listeners can download and use, a budgeting spreadsheet that's based off of one that I use personally. And it also provided a lot of questions. So we asked people on Instagram for any questions they had around budgeting. And we had so many that I thought, well, let's turn it into a podcast, because there's some very valid questions about how to budget, how to improve their chances of being successful. And so we're going to do a section focused on answering your budgeting questions.
And so let's start with the first piece then. Laura, welcome back to the show. What are you going to be chatting about today?
Previously on the pod, we've spoken about the rising cost of energy prices, food prices, and giving some suggestions of how people might deal with those. Something that's caught my attention this week is a new initiative from Iceland, a supermarket, who have partnered with a charity to develop what they are coining as ethical microloans that people who are struggling with food costs can take out to help cover the cost of their food shopping, either with Iceland or with the food warehouse. So firstly, the reason that this was of interest to me was I felt immediately uncomfortable about the idea of taking out a loan, taking out a credit agreement for something like food shopping, this essential shopping that we all have to do. And looking into the details of the loan, on the one hand, it's empowering people to be able to take control of the way that they're financing their food shopping, perhaps stopping them from taking out very high cost payday loans or other very high interest borrowing, or perhaps enabling them not to have to use food banks or relying on those kinds of sources of support. However, once I started scratching away at it, the APR on these loans is 55.6%, which by anyone's standards is not cheap. Admittedly, because this is a short-term loan, you can take out between £25 and £75 over an 8-week period. It's only amounting to a few pounds of interest if you took out the £75 maximum limit. However, it is still expensive borrowing. The other thing that people who are considering this need to bear in mind is that in order to get the loan, you will have to go through a credit check. This will appear on your credit file with Experian, Equifax and TransUnion. And if you can't afford to repay the loan, that will also, after a 30-day period, be reported to those credit reference agencies and could have a detrimental effect on your credit rating. So while the charity Fair For You says that it will never sell the debt on to a debt recovery agency, they do have mechanisms in-house to collect any outstanding debt. And this could include the money owed being deducted from the person's benefit income. So there is the potential that if you can't afford to repay the loan, that the interest will keep accruing on that debt, and that it will have a negative impact on your credit rating, and also that at a time when perhaps you're really struggling even more, you're having money then deducted from your benefits. So you can see that while this may be of help to some people, it's certainly not for everybody. And for those who are already really struggling with debt or in a vulnerable position, it could make things considerably worse. In answer to that, when we raised these points with Fair For You, they claim that these loans are giving people back control over their food shopping, that they carry out very detailed and exhaustive credit checks, and not only that, but look through people's bank statements and proof of income to ensure that they are the right sort of people to lend to, that this isn't going to exacerbate any debt problems. And they also say that they work closely with people who can't afford to make the repayments to come up with solutions that work for both parties. So I'd say that the takeaway here is that yes, this can be a useful initiative for some people. It's not going to be for everyone. And I think ultimately people need to be approaching this kind of loans for essentials like food with extreme caution.
Okay, great. Well, when I first heard this story, I was kind of quite excited that there was going to be a solution there. But as you've explained, there almost seems to be as many cons as there are pros. So it's a shame they can't find a solution that really works for everyone, that doesn't have those annoying negative side effects to taking out this kind of credit. So Laura, is there any other solution for people who are struggling to buy food without going down this route?
I'd say that there isn't a simple catch-all solution for this problem that's becoming endemic really in society, that more and more people are struggling with food costs, especially those on lower incomes. What I would say is that people should be looking at cash grants that are being offered by the government. So it's called the Household Support Fund, and governments are channeling it out through local councils. So it works slightly different from council to council, but a good first port of call if you are really struggling with food costs is to go to your local council and explain the situation and see if you might be eligible for this kind of grant. And the good thing with this kind of support is, as it's a grant, you don't have to repay it, and it can give you the same help but without the risk of having to take out a loan and having to pay interest on that loan or have it affect your credit rating, as we've spoken about. Also, obviously, it's far from ideal, and really, arguably, we shouldn't be in a situation in a developed country where we're having to rely on food banks. But it is worth noting that food banks are there. If you are really struggling, then I'd suggest that you, again, contact your local council about your nearest food bank, or speak to the Citizens Advice Bureau, who can also direct you to a food bank, who are there to help you if you are in the position of needing that level of help.
That's really interesting stuff. Thanks ever so much, Laura, for coming back on the show. Okay, so moving on to the next piece then, we're going to be talking about diversification. Damien, what have we got?
So this piece was inspired by a question I got from an 80/20 investor member. And I'm going to read it out. And obviously not name them, it's anonymous, to give you a sense of what they were asking. And the question was, I totally get equities, but I don't really understand bonds. I mean, I do, but what's the point of holding bonds and gilts if their returns are so low? And my understanding was that it is because they are safer in case something happens. Yet we have had an extraordinary year and bonds have been nosediving. I've read lots of blogs and articles, and yet I seem to be missing the point. I know this may come across as a stupid question, but I thought I'd ask anyway. Why on earth would you go for something that gives you a 2 to 3% return a year when you can go for something that offers you much more, like an S&P 500 tracker, for example? In what specific circumstances do you benefit from holding bonds instead of equities? I mean, you would have thought something so unlikely like a global pandemic would have been it, but yet look what's happened. I'm a little confused. Now, it's a very good question, and it's not a stupid one. I want to point it out to anybody who wants to write in and ask a question on the podcast. There is no such thing as a stupid question. If you're thinking about a question, it normally means there's thousands of other people who want to ask it but are too afraid to do so. Now, the answer to the question lies in diversification. So if you don't know what that is, then it's the idea that you hold lots of different assets because they tend to behave differently. So what you're doing is almost hedging your bets, to use a phrase. So different assets tend to behave differently at different times. And historically, bonds and equities have tended to have a negative correlation. So what that means is that when equities tend to go up, bonds tend to drop in value. So if you have a portfolio, very simply, that is made up of equities from wherever they may be, America, UK, etc., as a group, if they do well, then bonds, as they are seen as a safer asset, then they tend to underperform and they tend to lag equities. And in fact, like I say, if they're negatively correlated, if equities tend to go up, bonds tend to go down. Now, that's a quite simplistic view of things, because what actually happens is that relationship changes over time. It's never quite constant. And if you take the beginning of 2022, for example, which is why this is quite a relevant question, equities have tumbled at the start of 2022 as people became spooked about the outlook for technology stocks. If you go and listen to Damien's Midweek Markets, I explain more there. But also at the same time, bonds have been falling. It's all about bond yields, and it's all about the outlook for inflation and what central banks will do. But as I say, listen to Damien's Midweek Markets episodes and you'll understand a bit more. So that is an example of a period where bonds and equities actually are moving in tandem. And in this case, it's downwards. They can move up in value at the same time as well. So those correlations do change. But the point is that typically different assets will behave in different ways, and they may be more correlated to each other than other assets and vice versa. So if you go back and search on the Money to the Masses website, I looked at a concept called the perfect ISA portfolio, where I did some analysis and tried to find a portfolio, and did find a portfolio that was effectively an all-weather one. And by that I mean that it had always made a positive return in any given tax year since ISAs were created, going back as far as the year 2000, and it had outperformed the FTSE 100, and the asset allocation had remained the same. Now, that had at its core, and more than just its core, was bond funds. So they were these low risk assets. So it smooths out that volatility. So as I said before, if you think of a skyscraper and you think of the top floors being equities and the bottom floors being the safer assets as you go down that building, and you get to cash as the foundations, and on top of that, the lower floors are things like bonds. And then you move up that structure and you get different types of assets, including equities, and then you get the very risky assets, maybe investing in currencies at the top floor. Then when you get an earthquake, the floors that move the most are the ones at the top. The ones at the bottom are things like bonds, which don't tend to sway too much. And that is the sort of structure of a portfolio. So you'd much rather be at the bottom of a building than at the top of it in an earthquake. So bonds do provide a bit more of a defensive play in any portfolio, but it doesn't mean that their returns have to be completely useless. Now, if you go back and look over history, then yes, the return on bond funds is typically less than equities by some margin. There is a study called the Barclays Equity Gilt Study that looks at returns of investments over a 100-year period, and it looks at cash, it looks at bonds, it looks at equities, and the result is that you are looking at a return of maybe 2 to 3% from bonds versus 5% plus in excess of inflation for equities, and cash you're pretty much getting maybe 1% or something like that. So bonds don't necessarily provide an exciting return if you look at the long term versus equities, but that's because you're looking over a very long time frame. What bonds and lower risk assets do is provide some defensive buffer when things go wrong. So if you think about the pandemic that was mentioned in that question, yes, if you look at now, then US equity markets are way above where they were before the pandemic. The FTSE 100 has only just about got back to where it was before the pandemic. But that only occurred after the markets have fallen 30% and central banks intervened and started pumping lots of liquidity in the system, basically rigging the whole market effectively. And during that uncertain period, the assets you wanted to hold were UK gilts, because they started to outperform, because people rushed to gilts because they are an asset that is effectively a loan to the UK government, and so people expect the interest to be paid and also to get their capital back at the end. So people started to buy gilts and other high quality government debt. So you were actually starting to make a positive return during that period, whereas people who were just holding equities were licking their wounds that things were 30% down. But the key thing is as well, they didn't know they wouldn't go any lower, because you don't know where markets are heading. So with the benefit of hindsight, the best thing you could have done would have been just to hold equities and then be done with it. But the risks along the way were quite pronounced. And if you needed for some reason to access the money, or you were the sort of person who would crystallize losses, you could be sitting on some significant real losses. Now, the other thing to point out is that if you go back, and I think we did a podcast last year about the summer portfolio, and I did a piece of research for Aged 20 Investor, and there is a version of investing where the sell in May and go away phenomenon, where if you've heard of the adage, it's sell in May, go away, don't come back till St. Leger's Day. And there's a phenomenon that exists in markets. It's not always reliable, but that during the summer months, then they tend to underperform the performance of equities during the winter months. So there was this idea that if you sell out the markets, sit in cash during the summer, and then enter again when the St. Leger horse races run, which is in September, and then you're invested in the best part of the year. And that pattern of going from equities to cash does have some merit to it if you look at the historical numbers, but it isn't always reliable. I did a piece of research which looked at actually doing something a bit more radical and going into gilt. That really turbocharged that idea. And actually, when you looked at the performance and the volatility, or the lack of it, because you were spending half of your time in lower risk assets, then that would be quite attractive to some people because you were actually still getting a very good return from the equity part, but also from the gilt part during the summer. Of course, gilts themselves can be quite volatile, but the point I wanted to drive home is there are periods where gilts therefore outperform. So what I've also done is I've sat there and crunched the numbers going back over the last decade, and I've looked at all the unit trust sectors that are out there, the key ones I should say, which is about 30 of them, and I'm going to read them down, so bear with me, and the order I'm reading them is important actually, so bear that in mind. And I've looked at the return of all of the following sectors, and so they are the Indian equities, North American equities, UK smaller equities, property shares, commodities, global equity income, European smaller companies, which are equities again, UK equity income, UK all company shares, so they're things that are just like UK equities, global equities, so these are funds that invest in a range of different stock markets around the world and companies, North American smaller companies, so they invest in small companies in North America, technology stocks, European stocks, excluding the UK. Then there's flexible investment, so they tend to be multi-asset funds. Mixed investment, 40 to 80% shares, so they're multi-asset funds but have 40 to 85% equity exposure. Then infrastructure funds, healthcare funds, they invest in healthcare equities. Direct property in the UK, so that's more invested in bricks and mortar. Again, we've got some mixed asset funds with lower equity components. I won't go through those. Funds that invest in UK gilts, high yield bonds in the UK, then targeted absolute return funds. So they're the funds that do alternative strategies to try and limit the volatility. Japanese smaller companies, which again are equities, then broader Japanese equities, so not just smaller companies. Then we go down to Asian equities, some more bond funds, so strategic bond funds. They tend to be a bit high yield, but they're bond funds that are supposed to be strategic in their nature by being able to go anywhere, sometimes investing in maybe government bonds, sometimes investing in some slightly more risky loans to companies. Cash, so I've included cash. Then you've got global emerging market equity funds, global bonds, and you go all the way down till we get to Latin American equity markets and Chinese equity markets. Now, the order of that was important because that was the list from the best performing asset class in 2021 to the worst at the bottom. So the worst performing was the Chinese equity market at minus 13.5% last year. The best was Indian equities at 29.03%. Now, what I've done is gone back and looked at the last decade each year and produced a heat map. So visualize it in your heads. There's a heat map where the best performing asset in a given year is dark blue, and then it goes down to lighter blue, all the way down to the green, all the way down to the sort of greeny yellow, down to red, who is the worst performing asset in a given year. And I've done that for every year going back 10 years. So you can look for the dark blues for the best performing and the dark reds for the worst performing asset in a given year. Now, if you go to the show notes of this show, or more importantly, go to our website, moneytothemasses.com, and look for podcast episode 353, there will be an image in that post of this heat map. So what I've done is just done the colours. I've not put all the numbers in there to confuse things, but I have written to give some context for any given year what the actual percentage return was for the best performing asset and then the return for the worst performing asset. So you can see the range of assets. And this whole episode will therefore make you understand why you diversify. Now, if you look at that heat map and you look at those numbers, you will see that the range, so from the best to worst asset in a given year, is about 41%. So that means that in a given year, that the performance of the worst asset in a given year, whatever it was, on average, was about minus 9%. So if you pick the worst asset class in any given year, typically it was down about 9%. If you pick the best asset class, it was up 31%. So just over almost 32%. And that's why the range of getting it right or wrong is 41%. So you can see it really is a wide spectrum. So if you got it right every year, you would be obviously absolutely loaded, but you'd also be putting all your eggs into one basket. And that's why you don't want to do that, because the basket you could have picked could just as equally have lost you 10% every year. So you'd be sitting on a huge loss. Now, China was the bottom of the pile in 2021, yet if you go back just 1 year, it actually was one of the better performing asset classes, and it was up about 30% in that year. And so that is why you want to diversify, not just across asset classes, but within them. So these are equities, so you want to diversify within them, because if you put all your money on Chinese equities, you'd be pretty upset this year because you've just lost 13% versus last year, but you would have been up 30% the year before. And so that just demonstrates that there isn't any asset class that is predominantly always top. But if you go back and look at the chart, and you would be looking for the line that's got the most blue in it, the one that's been consistently blue. Now, in the last decade, probably the most likely place that you will have seen strong performance year on year has been tech stocks. And that's because growth has outperformed value for a considerable period of time. But it isn't always the case. It's not always the best performing asset class. It was twice, 2019 and 2020, but before that and in 2021 it wasn't necessarily the best performing asset class. As I said, it was one of the best performing but not the best. But if you go back, there is, for example, a wonderful example. In 2015, commodities fell nearly 24% in a given year, yet in 2016 they are up 58%. Yet the next year they were up 0.86%. The reason I mention those 3 years, because in 2015 commodities were the worst asset to be in 2016 they were the best asset to be in, yet in 2017 they were once again the worst asset to be in, even though they made 0.86%. So you can see that the point of diversification is there's not a consistent winner or loser across time. And in any given year, someone can go from the top to the bottom of the performance piles. But then this is where it gets interesting when you look at things like gilts, for example. Go back to 2018. And 2018, then if you invested in, say, European smaller companies, you would have lost nearly 15%. If you invested in quite a lot of equity markets, you would have been down. Because if you recall, we had one of the worst Christmases on record. I think it was the worst in about 70 years. Markets crashed into the year end. So it meant defensive assets outperformed. And in particular, UK gilts finished up the year in positive territory. Only just, it was less than 1%, but they still were in positive territory nonetheless. Whereas a number of equity markets were down in double digits. So that is a scenario where investing in bonds helps, because it was a scenario where there was a lot of fear at that point in time, and people started liquidating en masse the equity components of their portfolios. But interestingly, I then looked at what was the average return over the whole period. So the 10 years, not just individual years, what was the best performing asset on average? And yes, it was technology stocks, but most equity markets had returned more than double digits, except for UK equities, which were just below at about 8 or 9% a year. And looking at it, you could say that, the defensive assets were producing something in the region of about 4% a year, 3 to 4%. And I'm looking at UK bonds in particular there. So there is sympathy for the fact that, if you hold bonds for the long term, you will underperform a 100% equity portfolio, but your level of volatility will be through the roof. Now, there's nothing wrong. People can do that if they have the tolerance of risk, they understand the risk they're taking, and they have a long enough investment time frame. Those are all key things if somebody wants to be able to invest like that. It's their money, they can do, but they've got to be happy that they won't excess the money in the short term, and they are happy with those ups and downs and volatility. Now, if you go and listen to the Millionaire podcast that I did, which talked about investing for your children over the long term, I gave some great examples, which included portfolios that were almost exclusively equity based and looking at S&P 500 trackers. But with some of those products like junior ISAs, legally you can't take the money out, or the children can't take it out for 18 years. So with long investment timeframes, yes, you will tend to outperform over the long term because equity markets tend to go up. And that's because economic growth drives them forward. It's partly because of inflation too. So it is interesting looking at this. The other thing that was very prominent was the worst performing asset class over the 10-year period, if you held investments for 10 years, was cash. And so that just shows you that that's why people invest, because over the long term, you basically made an average return of 0.1% per annum, which is basically nothing. That is because obviously interest rates are at record lows and after the financial crisis. But that's one of the reasons why you need to start investing, because that's how you grow your wealth. Having money in cash doesn't grow your wealth because inflation erodes it. Now, one other quick thing before I move on to the next part of the show, is that things change over time. So if you looked at the first 5 years of the period I was considering, so 2012 to 2016, so that's a 5-year period. If you looked at the average performance of each asset class during that 5-year period, and you compared it to the average performance of the same assets, so the same comparative performance in the most recent 5-year period, so that is from 2017 to 2021, then these can change. To give you an example, going back in the first 5-year period up to 2016, UK equity income funds were one of the better performing markets. They were up there with other equity markets, returning over 11% per annum. But the most recent 5-year period, the return has only been 5% on average per annum. That's a massive difference, especially when you look at other equity markets where they have either maintained the level of performance they've had before, or the difference is only 1 to 2% different, i.e. less, or in some cases it's even greater than it was before. So what it shows is that basing your view just on a period of time like the last year, or in my case I've just done it for the last 5 years, and drawing conclusions that diversification or an asset class isn't worth holding is inaccurate, because assets do have periods of time where they will outperform, and it depends on the economic cycle you're in as well. So there's lots of other factors. So every dog does have its day at some point. So the key message is that there is a point in holding different assets at different times because it diversifies your portfolio. It's a bit like saying, is there a reason why you have airbags on a car and brakes or cruise control, all these different features that can be safety features or make things a lot more comfortable, rather than just drive 100 miles an hour and just run the risk of hitting the wall, but hopefully you won't and everything will be okay. If you're happy to ride those risks, then well, knock yourself out. But for most people, the reason that they will want to diversify is because they can't stomach the volatility and the paper losses that they could see if equity markets were to crash. And it's not all about just trying to shoot the lights out. If you go back and listen to past podcasts that I've done, when I talk about how you achieve financial goals, one of the biggest things we did with clients who were really wealthy in the city years ago was they would tell us what they wanted and where they wanted to be in the future. And then we'd work out what that require in terms of money and wealth. And then we would work back and factor in how much money they had today and what they could put into the future. And then you could work out a benchmark rate of return they would probably need per annum in order to achieve that dream. If that can be achieved by having a diversified portfolio, let's say it was 8% a year, that's what they really needed to do. They might have to take a bit of risk, but they had a diversified portfolio. It could be that it was as low as 5%. Then why would you run the risk of trying to shoot the lights out and go for a 100% equity portfolio when you just don't know what could happen in the future and your date of needing to access that money could be brought further forward? So that's why it's important. Don't worry about equity markets might be going up double digits every year and you might not be getting a full slice of that pie. If you've got a diversified portfolio, worry about your own benchmarks, worry about your own goals, and you're more likely to achieve them, because what you're doing by looking back at past history and seeing that, equity markets only go up, you do miss the fact that they do go down epically. And I'm looking at this sheet now, and the biggest falls could be as much as 20% plus in any given year. But another good example, before I finish this piece, of an asset that has changed over time, that has produced a lower return in recent history, has been Japanese smaller companies. So that is another asset class that in the first 5 years, so we're talking between 2012 and 2016, was the best performing asset class bar none out of the ones I've looked at, and it had an annual return of 20.5% on average for those 5 years. Yet in the most recent 5 years, that has dropped down to about 10.6% per annum, and it is one of the weaker equity market averages over the last 5 years. So it just shows you that things do change over time as well. So diversification remains important. And also, diversification can be really helpful in diversifying your income stream as well that you take from your investments. It's not just all about growth.
Okay, so let's move on to budgeting then. And this has come off the back of the Money to the Masses 28 Days Financial Fitness Challenge, which we're doing this January. Damien, you've done a really good video on this, and listeners of this podcast should definitely go and check that out. Go onto our YouTube channel, you'll be able to see it's one of the most recent videos that we've released. And off the back of that, you received lots of feedback and questions via Instagram, didn't you, Damien? You thought you'd collate all that information and kind of do a one-stop shop to budgeting and answer all those questions.
Yeah, so I'm just going to run through a whole bunch of questions that people have asked. So if you go to the link that's going to be in the show notes and in the notes on the website for this particular podcast episode, or you could even just go and search the 28-day challenge on our website or look at the highlight on our Instagram feed, you can take part in the 28-day financial fitness challenge now. You don't have to have started it before. It doesn't matter if you started it late. You can start it whenever you want to, and it will get your finances in shape in the 28-day period of very small, easy to do tasks every day and lots of resources that help you with that. And as part of it, you'll build your own budgets and you will build your own black book, which contains the information about your finances. So this week, we ended up helping people to start to build a budget, and we created a budgeting spreadsheet, which you can download for free, which is based upon a spreadsheet that I use personally. Now, if you want to go and find that, then you can go to it directly or via those pages on the website which are related to the 28-day challenge. The URL, if you want to go to it directly, is moneytothemasses.com/free-budget-planner. Now, the way it works, there's a video that Andy's already mentioned that will also link to that explains how the spreadsheet works and how to use it. But essentially, it helps you to quantify and control your spending and be able to start to build a budget. It puts things into needs, wants, and savings, stroke clearing debt, stroke investing. So there's 3 sections of your spending, with you ideally hoping to allocate more and more to the clearing your debt and investing for your future portion. But people have started to build their budgets, and we're going to help them next week when the challenge continues. But it obviously sparked a lot of questions, and I'm going to run through these. If you've got any questions, then please do send them in. We'll do another update to this in the future, or put them in the Facebook community and we can answer them in there. Also, please do share your own experiences, because I base this upon feedback that I've had, things that I know that work successfully, my own experience. But there isn't only one way to budget, and there's lots of different circumstances people have out there which they may find really useful ways of budgeting based upon their own personal circumstances. They could, for example, be a freelancer or something like that. Now, these are the questions that I'm going to rattle through. So the first question I get is, I'm apprehensive about using budgeting apps. Are they safe? Now, the reason that was asked was because I recommend that people use some of the budgeting apps. Now, Money Dashboard and Emma are 2 of the most well-known ones. And I was asked as well, which I might as well do this question at the same time, which are my favourite. They probably are my 2 current favourites. I do use them both. Money Dashboard is probably my preferred option. I use that way more because it has a huge amount of features that are all free. They don't have to pay for anything, and you can tinker with it to fit your own circumstances a bit better. Now, they work with obviously open banking, and they have to adhere to certain strict security guidelines, and they only ever get read-only access to your credit cards or bank accounts, for example. And so by using them, that collects all the information from those bank accounts and credit cards and puts it into one place. And they have very clever algorithms in the background, which therefore analyze your spending, so you don't have to go through your old statements like we used to do and try and work out how much we spend a month on food. It will do it in an instant. It will work it out for you, because don't forget, there's thousands of people using these apps, and their algorithms recognize the different retailers, etc., and will just put things into buckets like groceries, for example. You can create your own rules. You can change it and make it more bespoke to your own spending plans, but it allows you to be able to see how much you truly do spend on food a month, for example, rather than say, oh, I spend £300 a month, when in fact you're spending closer to 500 if you are actually analysing it, because it will analyse your spending not just from today forward, it will go back like the last 12 months and tell you what you've been spending your money on. So if you can quantify it, you can control it. I was asked whether you should use a budgeting app rather than the spreadsheet like the one that we've created. I use both, and the reason I use both is because the budgeting app is very useful for providing information, analysing your spending across multiple credit cards, across multiple bank accounts, because people obviously do spend from lots of different places in a given month. And by collating that down, it takes out the pain of trying to work out where your money's going. And so you can take that data, so how much you're spending, and put that into your spreadsheet, which can then analyze where your money's going in terms of percentage wise, and then look at how you can cut back. And then you can set a budget, which you can then input into the budgeting apps to say, right, I want to keep within this budget and something that is realistic. And then the apps will send you alerts if you're starting to break that budget, but you're also always using them in tandem. So I spend my life looking at my budgeting spreadsheet. I call it budgeting spreadsheet, but it could be called a spending plan. It's a more positive way of looking at it. So I know how we're going to spend our money, how it's going to be allocated. I look at that. That's on track. Okay, if I stick to my budgets, we should be okay. We should be able to meet our needs. Our discretionary spends should be hopefully under control. We are able to clear debts and put money aside. And the budgeting apps, therefore, are just a way of monitoring what's going on live as we go along without having to do any analysis. Every time I spend something in the shops, it drops into those budgeting apps and it then knocks it off of my budget. And I can look straight away and think, aha, I've got X amount left in my transport budget, for example. The more budgets you have, the better. So you could have one for maybe the amount of petrol you spend in a month, your food bills, all sorts of things, clothing maybe. Now, another question somebody asked is what percentage of your income should be put into savings? Again, that is something that's personal to you. There is one school of thought, we did it on the podcast previously, if you look at it, the 50-30-20 principle, where 50% of any of your net pay should go into your needs, 30% into your wants, and 20% into your savings or investments or clearing debt. That's a bit idealistic. I don't adhere to that because I think the world's moved on. Look at our energy bills. They're way more than they used to be of our spending. So I think the main thing is just to know what you're spending in each. Try and cut back on your needs. Try and eliminate as much of your discretionary spend that you really don't need to do as you can, and start trying to move more money into clearing debt and saving for your future and investing for your future. So that ends up making you more likely to become financially independent at some point in the future. The next question is, are there any tips for being able to be more successful? I mean, one tip I would say is create a buffer. So make sure when you create a budget, it's tempting to really go to the pence and have exactly how much you know what you on your average spend is a month and go, right, that's what I'm going to stick to. I think you should always give yourself a buffer. We did a podcast on it before talking about financial buffers. Search the website, you'll find it. But very simply, give yourself a bit of room, maybe round up to the nearest £10. So if you've got a budget that's £72, why not round it up to £75 or £80? And each budget will have a little buffer just in case you go over, because there are always unforeseen circumstances. And that way you won't become deflated because you're more likely to meet your budget. And if you have anything left over at the end of the month, you can sweep that across, pay off debt or put into savings or investments. Someone asked, what is the best way for me to clear debt while still budgeting for my essential bills? I mean, your debt, your minimum payments on your credit card will be one of your essential bills because you obviously have to pay your debts, the minimum amount you have on any loans or credit card, otherwise you'll default and then you'll end up impacting your credit rating. So they will be in your need section, your essential section as well. But you want to try and pay over those minimums each month. And the best way to do that is to cut back on unnecessary spending or increase your income. We did a piece on Instagram about trying to get a pay rise, and there have been podcasts we've done in the past. Again, go and search for them. There are tips on how to get a pay rise. So any savings that you make on bills or spending, rather than thinking, right, I'm going to then spend that on more stuff, put that on your budget to overpay your debts or save and invest. So increase that budget for that particular section. Is it worth paying the extra for the additional features on a budgeting app? Personal opinion, I don't think it is. I've not come across one that has features that are worth paying for. Again, I said Money Dashboard gives a lot of them for free. So I don't know why you would want to pay, but if you want to and it helps, then that's your call. But personally, I wouldn't. How do I change or manage my budget in the run up to Christmas or other expensive periods? Now, what you need to probably do is budget for those things for the whole year. Now, I know that I have certain bills in a given year. A lot of them are related to my children to do with certain classes or whatever that might come out every now and then. And I budget assuming that it's an annual bill. So I multiply up how much I have to pay at each given point in the year to work out the annual amount I have to pay, and divide it by 12 to work out the monthly amount. And then I start to budget and save money aside. So when I get to the point that I've got to pay a next instalment of that bill, I've already got the money in a savings account, so it doesn't impact my wider budget. I'm already budgeting each month. And of course, the other thing you can always do is do the roundups. You get a lot of banking apps now and budgeting apps. One like Moneybox, for example, they allow you to do roundups. So when you spend on your credit card or maybe your debit card that you've linked up, it will then round that money up to the nearest pound. And so the difference, like you used to do, where you used to put the difference, your loose change, into a piggy bank, it does the equivalent. You spend £4.60, it will round up to £5, put 40p into a savings account. That's what it does. That's a good way of saving money over a period of time for a year, for example, and have the money as a budget for Christmas. I've done it and I do it. And you can even double the pace of those roundups if you want. So rather than say 40p in my example, you save 80p. What is the best time of year to start budgeting? There isn't a best time. I think you just need to start budgeting now. Can I involve my children in budgeting to improve their understanding of personal finance? That's down to you. I try and talk to my children about budgeting, but that's normally because it becomes a conversation that has to be had when they want something. And I say, look, we can't afford to buy it this month. But everyone's different. And the other thing I would say is that there are some great techniques where you can start to teach your children about saving and budgeting. And again, it's the 3 envelope approach, where you get your children to put their pocket money and separate into one of 3 envelopes, one for almost immediate short-term spending, one for medium-term goals, and one for long-term goals. So they may have some money, they get an allowance, maybe a week or a month. They put some of it to go down the shop to be able to spend today, some of it aside maybe for something they're saving towards in the next couple of months, and then something that might be much more longer term, maybe a holiday in the next couple of years that they're really looking forward to, and they're putting some money aside so they've got spending money. By separating it out, they're then realizing that you need to budget, and you build budgets that way, yet they don't have to be complete sacrifice. They can spend money out of that short-term budget they've allocated. I have payments and subscriptions that I'm not sure what they are, but I am afraid to cancel them. Is there an easy way to find out? One way is to contact your bank and try and find out any information that you can. But normally, the direct debits give you enough information so you can work out who the company is and then ring them up and find out what the service is that you're paying and how to cancel it. The only thing I would say is that one of the things that will be happening in the next week on the 28-day challenge, you've got your budgets, you've quantified your spending, you'll look at your direct debits, your standing orders, and try to start to cancel ones that aren't needed. Be careful of just willy-nilly cancelling things, because you need to know what they are, because it could be something that you've signed up to. That could be something, for example, a direct debit for a debt that you've got that you're repaying, and you could end up defaulting or something like that. So it's always best to find out what the service is that you're paying for first and how to cancel it properly. And then ultimately you do need to cancel your direct debit, because there are ways, for example, if there's a service that you end up getting a refund, they might refund you via that direct debit rather than pay you money out. And that happens a lot with energy companies. How does an emergency fund factor in when budgeting? That's simply that you need to start building one. So that becomes one of your pay yourself first, one of your standing orders that's part of that saving stroke repaying debt stroke investing section of your budget, that you're starting to build up that buffer. So it is part of it, and you start to budget to allow yourself to build up a financial buffer. 3 to 6 month earnings is typically, or 3 to 6 months expenses, another option, is typically what people suggest. The more money you can do, the better. I mean, people would have found the pandemic quite difficult on just 3 to 6 months savings. And so there is one school of thought that maybe we should start pushing it to 12 months. I've got a bit of money left over at the end of each month and I want to invest it. Is it worth it, or should I leave it as accessible income? Now, again, always make sure you've got accessible income before you start investing, because it can be difficult to get the money out of an investment depending on what it is. And also it might force you to crystallize a loss if you have to access it. So build yourself that cash buffer that I mentioned. And then, of course, start to invest. There are places that you can invest. For example, go and look at the best investing apps on our website. There's an article that explains places that you can start to invest with as little as £1. And also look at our best stocks and shares ISA article. So there are plenty of places where you can invest without having to do much work. So you can end up having the portfolio run for you with as little as £1. So the most important thing is to start. Once you start, then you will start to, over time, increase the amount you're putting away. And that's how you build wealth for the future. So yeah, absolutely. That's just the first step. putting a couple of pounds a week, £5 a month, whatever, aside and start to increase that over time. Someone asks about, I get paid weekly, so find budgeting difficult as my bills are monthly. Any tips? That's kind of the counter to what I was talking about earlier, really. So what you need to do is just multiply up your earnings. It's up to you. Whatever your pay period is, you don't have to work on monthly. You can work on weekly budgets. For example, you could work on 2 weekly budgets. But the point is that they have to be consistent. So if you have a bill that comes out once a month and you get paid twice in that period, then in each of those pay packets, you need to budget half of that bill. So it's just being sensible, working out how frequently your bills are and making sure you're budgeting ahead of their payment and working out how many pay packets you have before the bill comes and then simply dividing it down. So it shouldn't be difficult. One thing that is hard, I suppose, is if you have earnings that fluctuate quite a bit. And in that instance, I mean, I've in the past, when I've had circumstances where that's occurred, I've always veered towards the low end, so my weakest months, and tried to budget based on those months. So if I had a month where, or period of time where I didn't earn as much as I thought I would do, then I wouldn't have to panic. And I'd also put aside more money in the months where I was earning more, so I actually received more income. It's about managing that process. And anybody who's been perhaps self-employed or freelancers for a period of time will know full well what that's like. And the other thing, I've just put it in here actually now, is if you are earning money which you need to pay tax on subsequently, so it's not through PAYE, that needs to be put aside into a savings account straight away. So don't sit there and think, I will eventually work out what I owe in tax. You can get the tax calculators out there that can tell you, and some of them on the HMRC website, that can tell you the kind of tax that you need to be putting aside from any payments that you receive. Put that straight into a bank account, which has got a sort of a label on it that you've put on there, maybe in one of your budgeting apps that says tax, and you're working out an over budget for that and put it aside, and then you're working your own personal budgets off your net pay. So when your tax bill comes, as it will do in a couple of weeks at the 31st of January, you're just taking the money out of the savings account and paying whatever you've calculated or your accountant has told you to pay. So again, it's a form of budgeting. So you've got to make sure you do it even for your tax, or perhaps even most importantly for your tax, because a tax man always wants to be paid.
Yeah, and as you say on that last one, Damien, because I'm someone who's done accounts and worked in accountancy in the past, if you budget for the worst case scenario, anything that's left over is a bit of a Brucey bonus, and you can then use that money to either spread back over your budgets or put to discretionary spend. It's kind of like an extra little savings fund on top of the savings fund for your tax, if you know what I mean.
And it is difficult managing all these different timings, but that's why you need to be in control of it. And when you feel in control of something, I tell you what, the feeling is positive, and it's something you have to keep reviewing, because like anything, it's like you're tending a garden. If you don't tend it regularly, it starts to go a bit wild. And so we all do that. We all start to realise we're overspending on our budgets and things like that, which is why having that combination of budgets, budgeting app, budgeting spreadsheets can make it just a 2-second job that you're just tending the garden, pulling up the weeds, and starts making it feeling less of a burden.
Okay, so that's it. We're done for this week. If you want to get in touch with Damien, you can do so in the usual way. It's Damien at moneytothemasses.com. Twitter, it's at moneytothemasses with the number 2. Don't forget to head over to Instagram and check out that 28-day financial fitness challenge if you haven't already, because all of this content that we're doing this month is kind of being based on that. And there's loads of stuff over there. Even if you think you've got one thing nailed, there'll be something in there that I'm sure you'll make use of. So, Damien, that's it. We're done for this week. Until next time.
Until next time.